Well, like you said, when you're in a great market, everybody's a genius. And that's absolutely true. I think we are going into a market that is probably not so great. And some of those pro formas probably are not keeping up, not just for you, but for many, if not most, sponsors nowadays. And so I feel like some common themes among those who passively invest in real estate right now are fear and uncertainty. The third one may just be like apathy, like they're just not paying attention to it because they don't want to
Totally.
know, the whole bury your head
Oh
scenario.
yeah.
But fear of what they're seeing and fear brought about by the uncertainty itself of what the future holds. What questions should investors be asking now that might be different from the questions they were asking in the boom times, say a year ago?
Yeah, absolutely. I think here's the challenge that passive investors always have is you're always at a disadvantage because you're only being told what that operator or sponsor is saying. And so you have to trust them at face value. So anything you can do that can like trust but verify is really good. So I always want to give someone the benefit of the doubt that they're trustworthy and that they're being truthful. But then I want to verify as best I can. So looking at past deals and understanding what level of accountability do they set for themselves when things don't go according to plan? Because that's the other big tell, right? Because like you said, most multifamily deals right now are challenged to some level, some a lot worse than others. So asking the question, how are you underwriting differently than you were a year or two ago in this environment, right? That's a really good question for a sponsor because it shows awareness. It shows areas that they maybe didn't consider before and how they have shifted their approach. And then does that make sense? Is that something that sounds right? And then to me, the biggest risk right now, aside from the deals that were highly leveraged with short-term bridge debt with floating rates in markets that are oversaturated, those deals are going to have a very hard time surviving, right? But a lot of deals it's going to be a bell curve, right? You're going to have some deals that were just very conservative, low debt, probably not as much multifamily, other asset classes that just aren't being hit as hard. You have the other deals at the other end of the spectrum that are the deals I just mentioned, the highly levered, short-term bridge debt in highly saturated markets. And then you have this middle part of the bell curve, probably 80% of the deals that are at some level of stress, but it's not distress yet. And it's understanding how do you get to the other end of the challenge. And so to me, the biggest things that have changed right now, aside from borrowing costs, right? And understanding what the interest rate environment has done, capital is very difficult to come by. And so understanding what cash reserves and what runway there is to get to a cash flow positive position if they're not already there, right? So cash flow, I heard this the other day that I thought it was so great, right? Cash flow in real estate, most people think of it as, hey, I'm getting current return on my investment. And that is what happens in good times. But in challenging times, cash flow is a defensive metric, right? It's a defensive mechanism because it can help you ride through all the turbulence, right? If you have enough cash to pay all your bills and to pay your lenders, then you can just keep holding on to the property until things get better because things will turn at some point, right? We know that real estate is very cyclical, just like every other business. And so understanding what's the cash flow position currently, if you're not in the cash flow position currently, what is the path to get to that and how are you going to fund that gap? And so I actually just did a podcast on capital calls, what they are, when to contribute into them or when not to, because that's what we're hearing consistently from investors is, I know in 2024, I have a lot of capital calls coming and I'm just getting ready for that. But then the next question is, how do I know I'm not throwing good money after bad? And some real quick things you want to pay attention to, but it's really simply that. It's one, understanding the initial capital structure, because there are some deals that they are too, the initial capital structure was too aggressive to where there's almost no way that the deal's going to make it. And that is if it was too highly leveraged to begin with, if it had bridge debt with floating rate interest rates, and it's in markets that are slowing down because we have a massive amount of new supply hitting the market. We have the most supply of new apartment buildings hitting through 2024 than we've ever had in history. It's actually a 60% increase over the next highest point in time from a new delivery standpoint, right? Because a lot of these deliveries, it take 2 to 3 years to construct and actually bring to market. So they all were started in the good times, in the boom time. Now it's all hitting as this kind of, plateauing a little bit. And so there's going to be deals that much slower lease up, much slower, much higher vacancy, et cetera, that are going to hurt the cash flow position. So cash and cash flow are the number two most important things. And then really understanding what's that path to cash flow, how are you going to fund that gap? And those are the biggest things to be asking questions about right now.